Hello and welcome to Trading 5 Talents. In today's video, I want to go over the stock replacement strategy. So what is the stock replacement strategy? It's when you exit your long stock position and then enter a leaps call option. So basically, you're replacing your stock position with a call option. So what are the leaps call options? Well, LEAPS is an acronym and it stands for Long-Term Equity Anticipation Security, which basically means it's a very long-dated options contract. So it can either be a LEAPS call option or there are also LEAPS put options, but the one we're going to be discussing today is going to be a LEAPS call option. So if we look at the profit and loss graph for just the standard stock, in this case, the example is MARA, M-A-R-A. This is Marathon Digital. So you can see here that when you purchase a stock at the current market price, in this case it was $10.93 when I took this screenshot, you can see as a stock goes up, obviously your profit goes up. That's the idea of a long stock position. If the stock goes down, you can see that you're going to start losing money as the stock depreciates. Now with a LEAPS option, a LEAPS call option in particular, you can see that the profit and loss profile is very similar. So with a LEAPS call option, as the stock price increases, the call option premium increases as well. That is, you're going to be more profitable. And that makes sense because when you purchase a call or you're long a call, you have a bullish outlook. Now, when the price decreases, and here's where we see the two differences between the stock and then this replacement of a LEAPS call option. So down here in the circled areas, with the stock, first of all, there is a greater capital risk because you purchased your stock at whatever price. If that stock for some reason goes bankrupt, it goes down to zero, obviously you lose all of that money. With a LEAPS call option, we're going to find out that it doesn't cost as much as purchasing the stock. And so you can see that your gain or your losses are capped at a much lower loss rate than the stock would be. However, the trade-off is when you purchase a LEAPS call option, since you're purchasing to enter that position, the stock actually has to increase before you reach your break-even point at expiration, and that's why you have this secondary vertical line. So the blue line in both cases is going to be the break-even. With stocks, it's just where you purchased it. That's your break-even. With the call option, the LEAPS call option, your break-even is the current price plus the amount that you paid to get into this position. Okay, so let's take a closer look at which particular LEAPS call strike that you would actually choose to replace your stock position. So the first thing that we need to understand is that since an option represents 100 shares of a stock, we're going to be replacing every 100 shares of long stock that we own with one LEAPS call contract because it represents 100 shares. Now, to choose the best LEAPS call option, these are the characteristics that you want in it. First of all, you want the delta to be as close to 1.0 as possible. Now, you can't get exactly a 1.0, but you want it close to 1 as possible. And in contrast, you want the theta as close to 0 as possible. Now, the deltas and thetas, these are two Greek values that are associated with options contracts. If you want more information about the Greek values and how it relates to options pricing, then I'll make the link available so that you can learn more about the delta and the theta. Now, this strike is going to be about half of what the current stock price is. So for example, if the stock is trading at $20, you're going to probably want the strike of $10. That's probably going to be your closest fulfillment of the delta and the theta values. So basically, you are purchasing a very deep in the money call option. So that ITM means in the money. Now, ideally, this call option, this LEAPS call option, is going to cost about 50% less than buying 100 shares of the stock. That's ideal. Now, it's not going to be exactly 50, depending on the volatility. It might be a little bit more, or it could be a little bit less. But these are the conditions in which I personally would do the stock replacement strategy. Delta close to 1, theta close to 0, strike is about half, and then it should cost about half as much as if you were to purchase 100 shares of that stock at the market price. Now, let's go ahead and take a look at the options chain to see an example. Again, we're going to use the example of Marathon Digital, ticker symbol MARA. This is just an example. This is not any type of trade recommendation. I'm just showing you what this strategy would look like. So right now you can see that MARA is trading at $11.15. So what we would want to do is we're looking to replace the stock holding that we have, the long stock that we have, with a long leaps call option. Now let's just say that we entered, let's say we're bag holding this particular stock, which I am, by the way. So let's say the entry price where we got in was $20, and now you can see it's trading down at $11.15. So we're deep in the hole with this particular position. So how would we replace it? Well, first of all, we'd go to trade options, and what we're going to be looking for is a very long term or long dated expiration of this stock. Now, I would, if it were me, I would go out for about a year or longer. So I'm going to go to January 19, 2024. So this gives me about 15, 16 months before this option is going to expire. So let's take a look at buying a call for the January 19th, 2024. The current price of MARA, as you can see here, is $11.15. So what we're going to be looking at is about half of that. So half of 11 is about $5.50. So $5 is pretty close. So if we tap on this $5 call option right here, let's take a look at the Greeks. Okay, so we come down here and we can see the delta is 0.9. So that's a 90 delta. And the theta is very close to 0. All right, so what does the delta tell us? Well, first of all, the delta tells us the percentage that the option moves in relation to every $1 movement in the underlying stock. So if MARA moves up $1, this call option is going to move up 90 cents. If MARA moves down $1, this call option is going to move down 90 cents. So we want to do a replacement strategy, which means we want our call option to mimic the price movement of the stock as closely as possible. That's the idea of a replacement. That's why we want the delta to be close to 1. All right. Now for the theta, this is a measure of time decay. So for every day that we hold this option, the theta tells us how much money we're going to be losing. In this case, it's $0.0026. So this is going to be about a quarter of a penny every day. So when you hold a stock, obviously there's no time decay, no theta decay. So you can hold it forever and it's not going to decrease on its own unless the price goes down. But options aren't the same way. So when you hold it, the value of that option, even though the price of the stock stays the same, the value of the option will actually go down because of this theta decay. So that's why we want it as close to 0 as possible. Now this is a very low theta, and theta will increase as we get closer to the expiration. But for now, there's really no time decay with this long dated options contract, this LEAPS contract. All right, so how much does this cost? So if we were going to go to buy, you can see that it's $7.45. That's the asking price, right? So $7.45. Now, when you purchase this, this gives you the right, but not the obligation, to purchase MARA at $5 per share. So because it represents 100 shares, this $7.45 call contract is actually going to cost you $745, as you see right here, $745. Now, how much would it have cost to purchase MARA, just right at market price? Well, you can see the MARA price right here is $10.93. I think that's the aftermarket price. If we went back here, you can see the share price is $11.15. So let's just say $11 for this example. So if you purchased 100 shares at $11, that would have cost you $1,100. But if you purchase this particular call option, then it's going to cost you $745. So yeah, it is more than half of what you would have paid, but you can see the delta checks out, the theta checks out. So maybe this is the ideal call option that you'd want to purchase if you're doing this replacement strategy. Let's look at the 7.5 call, because you can see it's only $645. So if we tap on the 7.5 call, you can see the theta again is down to almost 0. So maybe a half a penny a day. And the theta, or the delta, is 83 though. So when I do these stock replacement strategies, when I buy these leaps, I should say, I am looking for a delta of around 90. and then my theta less than a penny. I wouldn't have chosen this one. I would have chosen the $5 call option. So let's go back and let's talk about why we would even want to do this stock replacement strategy. So what are the advantages and disadvantages of replacing your long stock position with a long leaps call option contract? Well, the first advantage is that it's going to free up capital for other trades that you could make. So in my case, since I'm bag holding this particular stock, all that money, all that value is just sitting right there. So if I can replace my stock, get some capital back, then I can go and make other trades and still have the same potential profit exposure by holding this leaps contract. Another advantage is that you can still sell covered calls against this leaps contract. So it really is a very legitimate replacement for your stocks. So if I owned 100 shares of Mara, I could sell a covered call against it using my shares as collateral. Now, when you own a leaps option and you don't own any shares, you can still have a short call in play, and now your long call contract, this leaps call, is going to be used as the collateral. And so basically you're just making a diagonal trade. So this is what is referred to as a poor man's covered call. Instead of purchasing 100 shares, let's say for $1,100 in our example, now you're purchasing one leaps contract for $745. It costs less money, but you can still sell covered calls against that leaps contract. Another advantage is that there's simply less risk and less exposure to any downsides that you have with just owning the stock outright. So, for example, $1,100 potential loss or $745 potential loss. So obviously you would want to lose less, therefore the $745 would be more appealing. So there's just simply less overall exposure or risk when you purchase a leaps option versus 100 shares of the stock. Now, what are the disadvantages? First of all, this is going to create a taxable event. So if you're doing a true stock replacement, that means you already own the stock. So when you sell the stock, that creates a taxable event. If you're up on the stock, like you're profiting, then obviously you're going to incur some capital gains taxes. Whether it's short-term or long-term will depend on how long you've been holding the stock, but there will be a taxable event on it. Now, if you're losing money on the stock and you think, well, I can just sell the stock, I can take that loss and that will be a capital loss, therefore it will reduce my tax burden at the end of the year. Well, if you go ahead and purchase a leaps call contract, that is going to count as a wash sale. Therefore, you're not going to be able to write that loss off. So just because you're losing doesn't mean you're going to be able to get that capital loss on your tax record if you go ahead and purchase an options contract that replaces the shares that you sold. So this is going to be a wash sale, so you're not going to be able to get that capital loss. All right. The other disadvantage with options, as with all options, is that there's theta decay. So as you get closer and closer to your expiration, there's going to be a lot more time value that is going to be removed from that options premium. This is why you would want a leaps contract. This is why you want something very long dated, so over a year preferably. Another disadvantage is that there are no dividends and there's no voting rights when you exchange your shares for an options contract. So because you no longer own shares of that company, if it paid a dividend, you're no longer entitled to it. If you are a shareholder, you have voting rights. Well, if you own options contract, you obviously don't own the shares, therefore you're not going to have the voting rights. So if those things are important to you, then obviously this may not be the way you would want to go. But you can look at the advantages and the disadvantages, and you can decide for yourself if you would want to replace your stock with a leaps call contract. All right, now let's take a look at when we would want to use it. So what are the ideal situations or scenarios in which we'd want to replace our shares with a leaps contract? Well, if you're in my case, you're just bag holding. So I'm holding a lot of shares right now, and I am basically underwater with these shares. That is, the current price of the shares that I'm holding is way below where I got in. Right, with some of these shares that I'm holding, I'm down over 50%. So if we were to use the example of Mara, once again, it's currently trading around $11. Let's say your entry price is $22 and you're down 50% on that particular stock. Yeah, you're bag holding. You can sell the stock for a loss and just take the loss if you want to, or you can replace the stock. And that's what I'm doing with some of mine. I'm not recommending that anyone else does it. I'm just telling you what I'm doing, and I'm showing you the reasons why I'm doing it, and just maybe it might give you some idea of how to manage your position if you're bag holding. When you're bag holding as well, when your current price or the current price of the stock is way below your entry price, you're going to find that the short call premiums at your entry price are going to be very low. So if you got in, let's say at $22 with Mara, if you tried to sell a covered call at $22 and the stock is only trading at $11, they might not even have, first of all, the strike at $22. And secondly, if they did, it's going to be extremely low. So you can sell a call that is below your entry price and risk getting assigned lower, which I've done before. Or you can not do anything and just hold the stocks, and then you're just bag holding and you're not making any money where you could be using that as collateral. Or you can do this idea of a stock replacement. So you can still have that same exposure to the upside, less exposure to the downside, but you can still sell these call premiums. Right. Another situation in which you'd want to use it is when you need or you just simply want more capital. If all of your money is tied up in stock positions, long stock positions, and you have no more money to trade, then you can do this particular stock replacement strategy. And now you can take some of that money that's tied up in just one stock. You can have that same upside exposure, still sell covered calls against it if you want, but now you've got more capital to take on other trades. For example, other stocks that have better premiums. And this is another reason that I'm doing it, because the premiums that I have on some of the stocks that I own, or the premiums of the options, I should say, on some of the stocks that I own are just lower compared to other stocks that I don't own that have better premiums. So I see a situation in which I can make more money if I had more capital. So I'm going to replace my stocks with these leaps options, and then go trade those other stocks and generate more profit while still sort of having my foot in the door with the current stock holdings that I have. Now, there are other ideal scenarios that I guess I'm not thinking of, but these are the two that I see. So if you have any other situations in which you would want to do a stock replacement strategy, then please leave a comment down below so other viewers and other traders can see if this might be a strategy for them. So if you have any questions, go ahead and also leave a comment down below, and I'll try to get back to it as soon as I can. And if you'd like to continue to follow along and view my progress as I trade options, trade the wheel strategy, and pay off my Tesla Model 3, then go ahead and click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.